Welcome back. In this lesson, we learn three methods to value private companies based on the income approach. They are the free cash flow method, the capitalized cash flow method, and the excess earnings method. We'll also learn the issues in estimating required rate of return for private companies. Let's jump in. In the last lesson, we've learned how to estimate pro forma free cash flow based on normalized earnings. As with all discounted cash flow valuation methods, the intrinsic value is the sum of the present values of all the expected free cash flows in the future, and the discount rate is the rate that reflects the company's risk. And you can probably guess where this is heading. Since it is impossible to estimate cash flows forever, at some point we make an assumption of constant growth. And the terminal value encompasses all the cash flows in the final stage. This terminal value is simply calculated using the constant growth model, which is the next period's cash flow divided by the difference between the required return and constant growth rate. For example, if FCFF is used, the terminal value would be the next period's FCFF divided by the WACC minus G. The intrinsic value would be the firm value. If FCFE is used, the terminal value would be the next period's FCFE divided by the required return on equity minus G, and the intrinsic value is the equity value. All these should look very familiar to you, as they are exactly the same as for public company valuation. The naming, however, is different, as it is called the capitalized cash flow method here, and R minus G is known as the capitalization rate. At this point, we should also point out that analysts prefer to use comparables method to value private companies, which we'll learn in the next lesson. The CCM is more appropriate for companies with little comparables, and stable growth is a reasonable assumption. So, as you can see, nothing really new here, so let's jump right into the example. Let's continue from where we left off from the last lesson. We've estimated the pro forma FCFF or Morgan Textiles for the next year to be $17.962 million. Now, the valuator expects Morgan's FCFF growth to be 7% for the following 2 years, followed by constant growth rate of 4% in perpetuity. And based on the given financial information, determine the value of Morgan's shares using the free cash flow and capitalized cash flow methods. Pause the video now and work out your answer. And we're back. Let's first draw a timeline. We've already determined that the next year's FCFF is expected at $17.962 million. We're told for the following 2 years the growth rate is 7%, so these are the expected FCFF. Following that, we're told perpetual constant growth of 4% is expected, so here is where we apply CCM. The terminal value is at the end of the third year, calculated using the constant growth model. But first, we need to determine the WACC of the firm. Note that the current WACC of the firm is not appropriate as the capital structure of the firm is expected to change. Rather, we should use the expected leverage ratio of 40% to calculate the expected WACC based on the current cost of debt and cost of equity, which we are told to assume that there will be no change. So, using the WACC formula, we get 9.44%. Also, we need the next year's FCFF estimate at 4% growth. This works out to $21.388 million. Plug all the figures into the capitalized cash flow model, we get a terminal value of $308.47 million. With all the cash flows, let's calculate the firm value, discounted by the WACC of 9.44%. We get $283.48 million. Note that this is the firm value as we are using FCFF. To find the equity value, we subtract the market value of debt, which we are told to assume is the same as book value. This gives us $233.48 million. Next, let's learn the excess earnings method, which is also known as the residual income method. However, the approach here is very different from that of residual income models for public companies. The general idea is that the tangible assets of the private company, that is the fixed capital plus working capital, are fairly valued. But the intangible assets are not. The way to value the intangible assets is to assume that a firm's excess earnings are a result of returns on the intangible assets. In order to estimate the excess earnings, we first estimate the normalized earnings, which we learned in the last lesson. Let's assume the normalized earnings for the private company is $100,000. Next, we calculate the required return on fixed capital and working capital based on estimated discount rates that correspond to their risk, so the excess earnings in this case is the normalized earnings in excess of what is required. For example, suppose the company has $600,000 in fixed capital, and if the estimated discount rate on fixed capital is 12%, the required return on fixed capital is $72,000. And if net working capital is $200,000 and the discount rate is 6%, $12,000 return is required from working capital. The discount rate for working capital is usually lower than that for fixed capital because the risk is lower. Since normalized earnings of $100,000 is $16,000 in excess of what is required, the excess earnings of the firm is therefore $16,000. Take note that this is not the value of the intangible assets. Rather, this is the earnings generated by the intangible assets for the year. So if we assume a constant growth rate of excess earnings and a required return on the intangible assets, we can estimate the intrinsic value using the constant growth model. So if the discount rate is 14% and rate of growth is assumed to be 4%, the value of the intangible assets is estimated to be around $166,000. So if we total up all the different types of assets, the value of the firm is $966,000. In practice, the excess earnings method is not frequently used, other than for small firms with significant amount of intangible assets. This is because the discount rates for all the different types of assets can be difficult to estimate. And on the topic of discount rate, let us discuss some of the issues and challenges in estimating discount rate for private company valuation. Firstly, in an acquisition context, some analysts may use the acquirer's cost of capital to value the private company. This is technically an incorrect approach, as the acquirer's cost of capital is likely to be lower than the target's. So the acquirer will, in a way, be paying a higher value than the target valued using its own cost of capital. This extra value is what the acquirer brings to the table, so it shouldn't be paying for it. The correct approach should be to use the target's own cost of capital instead. Another challenge is the difficulty in estimating the change in WACC after an acquisition, due to the uncertainty over the capital structure. Pre-acquisition, the WACC of a private company tends to be higher due to less access to debt financing. If the capital structure is expected to change after the acquisition, the analyst may have difficulty determining the proportion of debt and the change in the cost of debt. The other aspect of WACC is the cost of equity. For public companies, we often use the capital asset pricing model, which is the risk-free rate plus the beta times equity risk premium. However, private firms tend to be smaller than public firms, so some may argue that the CAPM alone may not accurately capture all the risks of the private company. This is also the reason why some US tax courts have rejected the use of the CAPM for private firms. As such, some analysts may add a size premium to the discount rate. Another premium that is added is the firm-specific risk, which is a measure of the unsystematic risk of the company. This model is called the expanded CAPM. The size of this premium is sometimes estimated based on the discount rates of publicly traded small-cap stocks. However, such reference data may be biased upwards, as many of the small firms in the sample are experiencing financial distress. For both the CAPM and expanded CAPM, the beta of a private company cannot be directly estimated because the company's stock is not publicly traded, so there is no history of price and volatility. Rather, as we've learned in earlier topics, the beta is indirectly estimated using the beta of comparable public company stocks. However, if there are no publicly traded comparable companies, the beta can be dropped. Many researchers view beta as a reflection of industry risk, so an industry risk premium can be added in place of beta. This is one implementation of the build-up method, which is simply a generic model for risk-free rate plus a series of risk premiums. And let's conclude with an example. An analyst is working to value Privy, a family-owned restaurant chain, using the income approach. To determine an appropriate discount rate for the firm, the analyst made the following estimations. Estimate Privy's cost of equity using CAPM, expanded CAPM, and build-up method. Pause the video now and work out your answer. And we're back. This shouldn't trouble you much, as it is merely plugging in the appropriate figures. The cost of equity using CAPM is 13.4%. When we use expanded CAPM, 16.4%. And using the build-up method, 14.7%. Note that for this implementation of the build-up method, we've dropped beta and added industry risk premium in its place. Now let's say the analyst decides to use the cost of equity from the build-up method to estimate the company's discount rate. Privy's current debt-to-total capital ratio is 5%, but the analyst believes that its optimal capital structure is at 15% debt. He also considered the ratio for public listed restaurant chains, which is 25%, but he felt that it is inappropriate as Privy is much smaller than the public listed companies. Calculate the appropriate discount rate for Privy based on its optimal capital structure. Pause the video now and work out your answer. And we're back. Based on the optimal capital structure, weight of debt would be 0.15 and weight of equity would be 0.85. Plug in all the relevant figures and we get a WACC of 13.23%. And that concludes this lesson on the income approach to private company valuation. Up next, we'll learn the second approach, which is the market-based approach.